Welcome back. Many of us are putting money into a 401k account every month, but we could be making simple mistakes that could cost us a bundle of money by the time we reach retirement. Local financial professional Mike Kojonen is here tonight to share some of the biggest 401k mistakes and how to fix them. Mike, as always, good to see you.
And good seeing you as well.
Thanks for being here. Let's start there. What is the biggest mistake that people are making when it comes to their 401k?
Biggest one is just not contributing at all, which we see a lot of people doing, and not even putting enough money. You know, pensions are becoming a thing of the past unless you're a federal employee or, government worker. So employers are using the 401k system for your retirement. So you need to start investing as soon as you can. You're going to need as much time as you can to invest for retirement. So if you're under age 50, you can contribute up to $19,000 a year. If you're 50 and older, up to $25,000 a year as of this year's numbers.
And company match is so important, we know, but I guess along the same lines, many people are not taking advantage of that either.
Yeah, 1 out of 5 workers are not putting enough money to get that free money. So if you're contributing 3% and employers matching 5%, you're missing out on a couple percent of free money. And the biggest fear for retirees is running out of money before they're running out of their lifetime. So by missing out on that couple percent and letting that money compound over 20, 30, 40 years, it could be the difference your retirement being solvent or not solvent. So get investing as soon as you can.
Let's talk about some of those other mistakes that we make, because there are a few to highlight.
Yeah, a couple of them. Auto enroll, not changing it. So when you start working with employer, sometimes you just set up, I just take out 3% on my paycheck or 4%. And then you're there 5, 10 years later and you never adjusted it. As you get raises, you need to keep increasing those auto enroll amounts. Don't just let it sit there. You should be up to 10 to 15% of your paycheck, and hopefully get up to that maximum match of, that maximum contribution of 19 or 25,000. So keep increasing those and don't keep it set at that certain percentage.
And we also are paying too much in fees, another mistake that many of us make.
Yeah, the average is about 1% in fees. I've seen them as high as 3.5% in fees. Most people don't see the fees at all on your statements because it's not showing up all on the statement. They're kind of hidden in the cost of the investment. So do your research, because there's different allocation options. Some are less expensive than others. And if it's a past employer or you're 59 and a half, you have ability to roll that money to an IRA and pick and choose your plan and the fees associated with it. Most plans are lower than that, and some are even no cost at all in an IRA. So look at those options.
And people will often withdraw money too soon, another common mistake.
They do. I tell clients all the time, your retirement dollars are meant for retirement, not to pay off credit cards, a trip, buy a car. And if you're in a 22% tax bracket today federal, and the state of Minnesota is about 7.5%, you're almost 30% taxes. If you withdraw $20,000 as income from your 401k, you're going to be paying about $6,000 in taxes. And if you're under 59 and a half, that's additional 10%. So just don't do it. Find some other way to get your money.
And not withdrawing on time.
Yeah, now you hit that magical age of 70 and a half, the IRS is going to require you to take out your required minimum distribution. And that's a set percentage which keeps increasing every year you get older. If you miss taking out that amount, it's a 50% penalty. So if your required minimum distribution was $15,000, the penalty for missing it is $7,500. A couple other keys on here. If you're looking to roll that money to an IRA this year and you're 70 and a half this year, you must take out your required minimum distribution out of the 401k before you roll it over, or the IRS will penalize you. And if you have multiple 401ks, which a lot of people do, you can't take your RMD out of one account. You must take it out of each separate account, or the IRS will penalize you as well. That's why it's key to work with a professional who understands these laws, because they're very confusing. And you can download a RMD tax guide from my website at principalpreservationservices.com.
We'll, of course, link that to WCCO.com. A real eye-opener. It's really all about timing, and it's important to be paying attention to these things.
Yes, it is.
Okay, Mike, always good to see you. Thanks for being here.
Thank you.